Good morning and welcome to Fast Market. It's Wednesday, November 7th. I'm Tom White, joined on set by co-host of Fast Market, Kevin Hinks, and also the CEO of the Prosper Trading Academy, Scott Bauer. Good morning. Happy Wednesday, guys. One thing that we...
Relief rally.
Well, it's a relief rally,
Exhale.
And another positive thing, you don't have to see another political ad on TV.
Oh, believe me, today
That's the
starts
best part.
2020. What are you talking about? Have your breakfast. Once we get to lunchtime today, it's all about 2020 going forward.
Right. So we talked about this yesterday a little bit, Kevin, that we typically, no matter who takes over, what part of Congress, that we have some sort of relief rally. A lot of people are unwinding those pre-midterm election positions that they had on. We're seeing a lot of positive movement in the overall market, led by tech once again. Your take on this move, and is it susceptible to pullbacks?
Don't overcomplicate this.
Yes.
Uncertainty turned into certainty.
Yeah.
Period. And it was no major damage done on either side, and that's why everyone's starting to look back at now earnings and the overall economy. And bottom line is, since September 30th, the earnings expectations were about 19.5%. Now they're up around 24, 25%. So, you know, it's the resumption of, like I said, to make it real simple, uncertainty turned into certainty.
There we go.
Don't overthink it.
You're right, because now you have that cloud away from us. And Scott, we've got VIX down at near 17 again. I kind of wanted to hit on this because the other day, Joe Tagay was on, and he bashed me a little bit, and he said, "Oh, volatility is going to stay up here, and it's not going to break back down through 19." And
Well, it did through the election.
And I said, you know what? The volatility index, the VIX, is a mean reverting engine, and if that certainty that's back into the market because now the midterm elections are over, is what direction does volatility go here now that that cloud's over us?
So how much of the increased volatility that we saw was due to the midterms?
Yeah.
How much of it was due to China tariffs, Iranian sanctions, Brexit, and the rest of the headline risk that's out there? I don't know what percent exactly, but I'm going to tell you, I don't think VIX is going down much lower than where we are right now in the next month or so.
Right.
I think maybe we see a level around 16, but I think this level of 16 to 20 is the new norm, at least through the end of the year here, and I'm actually getting a little bit antsy here to start buying calls again.
Now, think about that. But, and this is what I told Joe. I said, I think it finds a new base around 15, 16, maybe hovers around there, maybe, you know, but I don't think it goes back down to 12 was my point, but I didn't think it rallied back down up to 25 also, Kevin.
Remember something, in terms of movement, remember, what does VIX equate to? Percentage moves, right, in the SPX.
Demand for
1.2% move today in the SPX.
Yeah.
Now it's up, so it's taken a little real VIX out, but that doesn't mean this market is any less volatile.
Right.
Than it was the day before. Matter of fact, I would say this is consistently volatile.
Yeah. And now we're off of those correction territory levels that we saw. FANG Plus leading us today as we've got Apple, Google, Google Alphabet, Amazon all up pretty significantly. But the dollar's down too, Scott.
Big move in the dollar.
And I think that's actually helping equities a little bit, these multinationals, because the dollar's kind of pulled back from that rally that we've seen over the last month or so.
It is a real big move, and that's another one I think is overdone on the overall equity rally today, is that the dollar, I think, is down too far. There's a lot of optimism out there, especially with the euro and the pound with Brexit.
Right.
That there may be in the next couple weeks, next 3 weeks or so, some sort of resolution. I don't know. That's still some pretty big headline risk to me, in addition to, you know, what's going on with the Fed, where I don't think anything has changed yet.
Yeah.
So I think the overreaction is a little bit too much in the dollar, and I would look for it to prop back up over the coming weeks.
Yeah, and we've got treasuries up, yields down today on this where the Democrats take over the House.
A lot of interesting aspects to this.
Yes,
trade.
there are.
European markets rallied strong on the pullback in the dollar a little bit, and the rise in their currencies in the Eurozone and the UK. So, Kevin, let's move it over to the next point of interest, and that was oil. So we had inventory data last night from API.
Big inventory data last night, and basically crude held.
Yeah. Crude held and was actually up pretty solidly in the pre-market and into the equity market open. And that was after
And then another body punch.
Until.
Yeah, that was after a 7.83 million barrel build in inventories last night in the API. 5.78 build today. Gasoline inventories actually built too. So that diversion that we saw the last couple reports is back in line. Your take on oil, because it's back, it's down now as much as it was up earlier, down over 1%.
Right. I mean, oil right now has got no real geopolitical risk to speak of, and at least none that's coming to the surface. And you've got inventories just hovering over this trade, and guess what? It's losing bids based on that. Now, oil's getting a little cheap here.
Well, it's the third or fourth straight week we've seen some pretty massive
I mean, the chart on crude oil is pretty ominous in terms of how quickly it's gone from 76 to 61 and a half.
Yeah.
That's been a quick slide.
Yeah,
and a lot of upticks.
And that was with the overhang from the Iranian sanctions, Scott, which you brought up. Do you see it finding a base here? Because we did some example trades to trade that ebb and flow that we talk about. We're short a 64-62 put spread in the December futures options, and then we did the 62-60 out in January. So we extended our neutral to bullish bet in here. But the Iranian sanctions, you've got to think that Iran right now is taking it on the chin, because you've got oil prices falling. They can't sell their oil. It's affecting their economy and demand slowing in China.
Right, but I think this 6-month reprieve, let's call it, I don't know if that's the right word, but the 6-month reprieve out there where 8 countries can still buy from Iran, can still import from Iran. No, not at all. Not at all.
Past those 8 countries.
Exactly. So I think that was a bit of a surprise, a bit of a shock to the system here. Is there a base here? I mean, I'm looking technically here, and we all like round numbers. The market likes round numbers of 60, but right below 60, there does seem to be in that 59 and a half area a pretty decent area there. So if you're looking to get long oil, probably not a bad place to start nibbling a little bit right now. Yeah. Don't allocate your entire position here. Yeah. Start nibbling a little bit.
And that's what Kevin and I did yesterday. We scaled in a little bit, but oil's still under pressure. We'll have to wait and see that. Is this theme of building inventory is going to end anytime soon? That's what we have to concern ourselves with. And also, the production's still ramping up here in the U.S. So
11.2 million barrels per day.
Yeah, that was a little bit lower than last report.
Well, at some point, I expect during this month of November for it to go to 11.3. It hasn't gotten there yet. I mean, I haven't seen it above that yet, but some of the expectations are for that area to ramp up production I think I read 98,000 barrels.
And Saudi Arabia is right there to ramp up production anytime needed also. So these countries cannot be liking the fact that oil's down below $62 a barrel at this point right now.
No, but also look at how quickly we went from the magic number of 10 million barrels a day, which was almost, unthinkable, that we went from 10 to 11.
Big hurdle. Yeah. All of a sudden it just went, shot through it.
So when do we get to 12? When does shale start pulling back? I mean, we're that's at record output also.
Right.
So.
And that's where they're continuing to ramp up production. Exploration's really huge there. A lot of people are actually putting more focus on that area because the ease at which you're trying to get that oil out of the ground in that Permian Basin. But what to wait and see on oil, see if it bottoms out here after another 1% drop. Now, not much economic data on the agenda today, but mortgage applications down 4%, lowest level in nearly 4 years as mortgage rates continue to creep up. The average 30-year fixed mortgage rate went up to 5.15%, which I think is causing some headwinds. We've got this sector, home builders, guys, in bear market territory. Is that going to continue? We've got D.R. Horton earnings tomorrow. Kevin.
What happens when this data comes out like this, and you saw it in retail 12 to 18 months ago. They don't just sell them, they oversell them. So some of these home builders are getting cheap, but it's a difficult trade right now because the economic data coming out on these are just big, and they're against you.
And you know what? I wanted to bring up that point because we talked about this last year with the retailers at the end of October. They oversold them.
Yes.
Heading into the holiday shopping season. And then you started getting data that was really positive. Good retail sales number, good Red Book, good chain store sales numbers, Scott, which helped provide that that bottoming in that retail space, and we've seen it rally ever since. But we're getting bad data in the housing market and choppy data in some of the housing numbers. Is that equate to more pain for this particular sector? The home builders, Toll Brothers, Lennar, D.R. Horton, Pulte, they're all down.
What's really interesting is you have a few of the CEOs of the big home builders actually coming out and being pretty bullish in the marketplace, which is just so completely, a 180 versus the data that we're seeing here. So what do you believe here? I look at rates, and my own personal opinion is we're going to get a rate hike in December, but I think that we then start to see the Fed maybe just ease up a bit. Yeah. So I look at that and say, okay, maybe we're at a short-term top on rates, which to me maybe gives some sort of rosier, let's put it, outlook for some of these home builders.
And think about this, Treasury's up today, yields down a little bit. Is that the market telling you that, hey, maybe this inflationary pressure, wages are going to start slowing down a little bit. GDP might slow down a little bit as getting bills and legislation through the administration is going to be a little bit more difficult. Maybe that cools off the economy a little bit, Kevin, and that's why you've got a bid into Treasury today.
I think what the bond trade tells us today is that 3.2%, it's going to be a little heavy in terms of volume. There's going to be some two-way paper trading about 3.2%.
Yeah.
So it's not just going to slide through 3.2 and go higher. You're going to have to hit a couple of bids to get through this.
That's right. We'll have to wait and see, because the Treasury market seemed to have it right yesterday, starting to catch a little bid, and we're seeing that pullback in yields today and a bid into Treasuries. Now, let's get to some trading and some example trades that we put on over the last couple days. And one I wanted to bring up first, we got to give a little kudos to our man Scott Bauer today on the set. CVS. So Scott was in your chair, Kevin, on Monday, and we did a CVS trade ahead of earnings. And Scott did something which we typically don't do, but I actually liked the setup for this trade, where he bought a 75 call 2 times, sold for the 78, so a $3 wide
$3 wide
vertical
on the long side.
On the long vertical, and then he sold 2 of the 78, 79, so he shortened that up, and I believe it's still on the Analyze tab.
So he did a butterfly basically that was bigger on the long side, shorter on the short side.
I like to call it a broken wing butterfly.
Yeah. So we're going to bring up.
I like to call it profit.
That's pretty good.
But it was, and here's
if you're right, that is a nice way to do it. Remember, it's 2 vertical spreads. But what Scott did is he made one a $3 wide, one a $1 wide, right? It's in the butterfly family, but here's what it is. It's what we talk about all the time here, Scott. You take the fundamentals of the strategy and you bring your own little imagination and talent into it, and you skew it to fit your opinion to it, and that's what you did.
And here is the Analyze tab on that particular position. We did it 2x4x2, so it's a straight butterfly, but it's skewed a little bit because the width of the upside short call vertical is only $1 wide instead of the 3. But we paid a debit for this. We paid roughly about 88 cents for this, Scott. So let's go ahead and take a look at this, at what it's trading in the overall market now. So we're going to create a closing order, and I want you to kind of tell me what you want to do on something like this, because it's trading a $2.05 credit, so you more than doubled your money on this initial trade 2 times. So what is your strategy here? Because you've only got 2 days to expiration. Do you leave it? Do you let it go, or do you max out? And you did it as an earnings play.
Right. It was completely done as an earnings play. So, and that's why we used this week's options. Okay. I like the upside. Now, there's the old adage, bulls and bears prosper, pigs go to the slaughter, right?
Yep.
So you analyze this, and in a perfect world, you always want a trade, a setup to go to your short strike.
Right.
So at expiration, we'd love to see this thing at 78.
Right.
What is the likelihood it's going to be right at 78 to pick up this extra 90 cents or so of additional premium that's out there?
The difference is between a $2 and a $3 is what you're playing for now.
Exactly.
Right? And actually, you need the stock for it to $3 to go down, not up.
Yeah, you got to actually needed to pull back about a buck
You
and a
need
half.
to go to that short. Remember what a butterfly is in the calendar family? Butterfly. It's about the short strike.
Yeah.
You know what? So I look at this, and again, this was not a long-term opinion.
Yeah.
This was specific to earnings. Get me out.
Right.
And that's good trade.
We're in the moving business.
We're in the moving business. Get me out. Let me take this.
And remember, if this goes through 79, the full value is $2.
Yeah.
Right now it's trading 207.
Yep. So why not just go ahead and close that? And I think that's a great way to look at trade management skills on something like this. What's your trade-off? Do you think the stock's going to pull back $1.50 on this big rally that we've seen? And it actually rallied right into the close because we were trading about 75.5 most of the morning.
WBA did as well.
Yeah.
Filled on that. Yeah, it's like don't try to be perfect. Just take your winner. You know, I had this discussion with Tom O'Brien from TFNN this morning. You know, there's a mindset sometimes in this world. I want to beat everybody. You know, and I said you don't want to beat everyone. You just want to win. Right? It's more important to just win than to beat everyone. Take your profits, move on to the next one.
2.5 times X. Let me put that money now towards another potential
Exactly.
Yeah. So we've got another position on. I want to hit this real quick before we talk about Square because they've got earnings. And this was an unbalanced butterfly. We only did 1 by 6 by 5 in this yesterday at Michael Kors. Michael Kors is down significantly, more than the anticipated market maker move, but it's still hovering around 49 bucks
in our
a share.
zone here, kind of.
We are in the zone.
So we're long one of the 52s. We're short 6 of the 50. 50s.
Right
no worries. We're short 6 of the 50 puts, and we're long 5 of the 48 puts. So we're in our range, right around our range, Kevin. So we've only got 2 days to expiration. What's our decision here on trade management?
I think because many times. How many times have you seen this, Scott? It goes through your strikes and then comes back into them because it gets, you know, a spike down and then it settles, brings in some buyers. There's some technical levels there, and it drifts back up. You see it a lot. And remember, it can go back into this zone right here. That is your main profit area. So I think you're patient. You're patient on this. The good news is you're risk defined. It's only $2 wide in terms of its strikes. So even the catastrophic loss is not catastrophic. So I think you still play a patient game. Now, something you can do. You can put in a limit offer. Right, and maybe it trades back into that range, and you can trade out of it. So there's a couple things you can do here to make yourself.
So the closing order is trading about 375 debit, Kevin.
Right.
We collected about 105 for that particular trade. So, but one thing I wanted to make note on this, Kevin, look at that. The high today is right under $50 a share. So that ability to go back to that optimal 50 strike is still in this particular trade. So we'll leave this alone.
It's a patient trade right here.
And we'll take a look at it tomorrow too. Also, because we want to make sure that our viewers out there are getting some good trade management skills here. Now let's turn to Square. Stock's up about $5 today, up over 6%. Now remember, this stock
yesterday, up big today.
Yep, up big today. Anticipated market maker move, if you follow me here to the trading platform, is about $6.40 going into this, plus or minus. Now, one key note with Square, guys, about 410 million shares, so not too light, not too heavy as far as the amount of shares going. But this stock can move, and we've seen it over the last several weeks, Kevin and Scott. Look at those moves that we've seen. It was in bear market territory. It's down 20% from hitting all-time highs on October 1st. 9% market maker move expected in this. But I wanted to hit on one thing, Kevin. We have a position on in here.
Yep.
Let's go ahead and monitor that. And we'll go down to Square. Here's our Square position. So we put on a stock replacement, Scott, before that October 1st. When it took a dive, or near that October 1st level, where we're long the March 75 call, so way far out in March, and we're short the November 9th. We paid $10.19 for this stock replacement. We've already rolled it once. We collected $1, so we're basically in this position for about $9.15. But we got to take into consideration, Kevin, that this stock was trading $65 a few days ago.
Yes, it was.
Really hurting this particular position. So what I want to do is create that closing order. It's currently trading, we've only have it on one time. We did it really small. It's trading $12.15. Give me your take on stock or trade management on this particular type of trade where, hey, before this thing was trading under $5 to close.
First and foremost,
big loser.
You've got profits on the table here.
Yes.
Right? It's made a great comeback, and we stayed with it for a reason. We were risk defined. That's what being risk defined gives you, that ability to stay with trade because it's not a catastrophic loss. So now you've got profits. Now what?
Yeah, we've got
an earnings
profits of
event
about
tomorrow.
$3 on this particular
You
trade.
got an earnings event tomorrow.
$300 profit on a one lot.
Right.
After this thing was underwater by over $5-6.
The key to me on this one is that you have earnings,
Yeah.
and which is just a crapshoot.
Yeah.
I would take it off, reevaluate. Maybe there's a different position to put on. Maybe you wait till after earnings. I'm taking this one off again, and then always know that there's going to be another trade to make.
Yep. I like Scott's theory on that. Kevin, yours.
The one thing, closing is obviously the easiest,
Yeah.
right? If you get a diagonal or a stock replacement strategy that's in the money like this is, and that 75 call is a big number, what you can do is roll them up.
Yeah.
Right, and make that net debit smaller,
Yeah.
and take some of the net debit you paid off the table.
Collect a credit
I love
on
to
an
do that
adjustment on
when I think there may be some downside risk. I don't know if there is,
Yeah.
but you've got some money on the table here. So
Yep.
there's obviously the first thing, close it.
Yep.
Right. Number 2, play the event.
Yep.
And do that. And number 3, just keep trading it and take some of the risk off the table.
Right. Okay, so we went ahead and closed that. But as one type of trade management, there's a couple different ways, and Kevin's included where you can actually take some credits, reduce some exposure on it. But now, because they have earnings and volatility, look at this, guys, on an aggregate basis. We've got November 9th weekly series at about 125% volatility on an aggregate basis, falls down to 85, down to 71, and so forth. So we've got some additional volatility in this name. And if you go to the option statistics page, current IV percentile, about 66%. But so we've had some pretty big swings in volatility this 52-week cycle period.
A stock selling off as much as Square did will bring some implied volatility.
Sure will.
Elevation.
Yeah, and think about that. When we did trade down to 65, I think that IV percentile rank was up near 100%. So that's why you're getting those moves in there. And if you look down here at implied volatility, you saw some spikes over here in the last several days, along with that last earnings report that we saw.
Even at these high levels, and even with an event coming up tomorrow, from where it was, you may get a little softening in the implied volatility going into this number, as you can see on the chart there. But still, remember...
Do you want to take advantage of this and try to maybe put on an example trade, guys?
Always.
Okay, let's do it. Let's do it.
We have to.
What are you
right?
going to look
That's
at
who
here?
We are.
What are you going to look at here?
This is the business we've chosen, Tom.
So what are we doing here? Do you think it's topped out again and that maybe it's got some downside? It's got some upside. $6.50 anticipated market maker move, Scott.
I'm going to look at an iron condor first and foremost.
Okay.
So trying to sell a downside.
Near term?
Yeah, this week.
Okay, this
Absolutely
week.
this
You got
week.
2 days to expiration.
Yep.
What type of probabilities could you want to be outside of that range, or at least near that range that's expected?
Right. So with a $6.50, expected market maker move or so, I probably want to go down about 25 to 30% past that. So I'm looking, maybe at the 74 to 72 area on the downside,
So
and
we'll
then
sell that put spread. There's a credit spread. We're only collecting 26 cents on the
not
$2
great.
wide.
Well, because that skew is heightened.
Yeah,
big time.
Because
It
of the
is.
implied vol.
And the upside, I'd probably look around the 90 to 92, somewhere in that range. But I'll tell you right now, if this thing lines up for about 45 or 50 cents on this iron condor,
It's about 52 is the midpoint.
that's a little cheap for me for a stock that's been
That's
trading
just not
this
hitting the right
volatile.
numbers.
And why is it cheap, Kevin? Because he's outside of that market maker move
Exactly.
range that we've got in here. He's about $8 on the upside on a short strike.
I just want to do a little test here and
Okay.
see if the 90.91 and the 74.73, if it's a better percentage return. No, it's
Yeah.
below
about
30 cents.
Below 30 cents
So
return.
remember, we talk about a $1 iron condor. You're looking for at least 30 cents and something above that. So 28 cents,
Maybe it's just a no trade, and then you trade it post earnings if it has a big move. I mean, sometimes you can look at it that way.
Well, let's keep going through some chances here and see if we get anything in the unbalanced butterfly.
Yeah, let's do this
Let's
one
go
quick.
82. Okay, we'll go 82. We'll go, how about 77, 75.
And Kevin's creating a long unbalanced put butterfly to collect a credit on it because he's going to skew the volume.
108.
Hey, you're
Closer.
close to what you
So
want.
75 is your mid strike. Then you can add the 107, so your
Right.
break-even point's just under $74 on this particular one, and that's about $8 out of the money to the downside. So Kevin's going to put that in 1 by 6 by 5, and we'll go ahead and manage that after earnings come out on that. All right, Scott's going to come back later on in the show. Coming up next, though, is Face Off. We're going to look at technicals versus fundamentals. We're going to look at Wynn Resorts ahead of earnings. Stay right here on the TD Ameritrade Network. Fast Market will be right back.
The pace is slowed, but they're still, 2.1% on the FANG Plus futures. That's telling you all you need to know about the NASDAQ in this market.
Yeah, we'll have to wait and see if that VIX can break through that 17 on the downside.
They love them again here.
Yeah, yes, they do. Yeah. Now remember, historically, post-election, that no matter who gets into office, that equity markets rally. So maybe this is pushing back against that fall that we saw in October. But I kind of want to get to one more name here that's got earnings after the close, Kevin, and that's Qualcomm. Pretty big moves in the chip sector overall, but Qualcomm's got a lot more on their plate than maybe the Intels and the NVIDIAs and the NXP semiconductor.
I mean, Qualcomm, actually, for everything that's going on in Qualcomm's world, pretty muted market maker move. Only about 5%, I'd call that.
And that's about near the 2-year average for this. Now, you got to remember, there's 1.5 billion shares outstanding here, so it's a kind of a big tank. But they do have some litigation disruptions, licensing disputes with Huawei and Apple as far as their chips. Apple's reportedly owes them $7 billion in royalty payments that they haven't received. Apple wants to go to litigation starting next year with Qualcomm and their licensing deals. I mean, does that create a headwind? Because Qualcomm's fallen from 76.5 down to 62.80.
I'll tell you, I traded a stock when I was specialist that was always in litigation.
Yeah.
Rambus.
Yeah, Rambus, yeah.
They were constantly in litigation, so you literally have to trade up until the mini judgments,
right,
and then trade through it, and then it was constant.
Almost like additional earnings reports.
Yeah. It was like a new event each
right.
time they had a date coming up on just like patent infringement. Same exact thing here. So, but look at the base that this stock has built around the 63 level.
Yeah,
pretty significant.
63. It's had a base over there, but like we said, it's fallen from 676.5 down to 62.80 or roughly. So now, Kevin, with you saying that, I just kind of want to give an example on maybe a trade in here, because Kevin's like, it's pretty surprising, only about a $3.40 anticipated move. Current IV percentile heading into earnings, only 57%.
It is not very high going into earnings.
Yep. Now, we did have that big slide, so that created some additional volatility. The near term, November 9th weekly is 84%, Kevin, right, on aggregate basis.
And remember something, for those people like, wait, it says 84.
Yeah.
And well, remember, it doesn't take in, remember, anything under 8 days, it doesn't come into this calculation. So that 80, see, it's really a focus of much more right here and those levels that is being looked at by that number.
Yeah, and then that November 9th weekly cycle that expires in 2 days. You got to remember, I always think about that near-term cycle with less than 5 days to expiration, less than 4 days. I always just think of it, don't look at the volatility, look at the premiums in there. Yeah, I always think of a premium trade. But I kind of wanted to hit on something that Kevin said. There's not a lot of premium in here. One way that you can take advantage of if you think that this stock's going to rip after results. Now look at that. Anticipated market making moves 340. 355 is the straddle, the long straddle. You analyze that trade. So
make no mistake, what you're playing for here is a move outside the
Either
range.
way.
Yep.
You've got the move, you've got the market maker move, you're playing bigger than that. So what you want, in a nutshell, with a long straddle, is a move as far away from the 63 strike in either direction as you can.
Yeah.
Some outlier news.
Yeah, some outlier news, maybe some guidance slippage, a little bit, maybe more litigation costs, legal costs into this. But that's a way to take advantage of something risk-defined where you think it's going to move. But we typically don't do that because volatilities and premiums.
But you're risk-defined. You only got $355 at risk if you pay $355, and what you're looking for is you've looked at that move, you've looked at the history of that move, and you said that's too little.
Yep.
That should be your decision-making process if you're going to buy that straddle. If you think that's fair, that's another trade. If you think it's too big, that's another trade. But that's the decision.
And you're making a good point here, Kevin, because we've seen, Scott, a couple 2-3 standard deviation moves post earnings out of some of these names, including Apple and some others, Amazon. Google Alphabet.
Fair amount go through the expected move.
Yes.
So that's why I kind of want to make our viewers give them different strategies that they can use based on their assumptions.
Can we go back to the option screen for a second?
Yeah,
here?
sure.
Because if we wanted to just mitigate some of that risk by still doing a straddle here, we could look to sell the wings.
Right.
We typically,
So a
like we
long
did.
iron condor,
Right. Or in this one, I think it's a long iron butterfly. They actually
exactly.
Now, would
call
you
it.
go down about the anticipated move, like $3 on each side of that 60?
I absolutely would, and if you do that here,
Let's take a look at it. I'm going to add a short strangle on this 66 and
getting
60.
some decent premium back.
Now you're down
here.
to 224.
You get down over $1 on that, about $1.25 less as far as the amount paid and the risk involved in that. Now,
But here's the problem.
Yes.
With this.
You're in.
Right?
Yeah.
You've got very little. Remember, the
little
spread
upside
can only
left.
go to $3.
Yep. Yeah.
And you're paying $2.24 for it.
Very little upside left. So that's
a way to lower your cost, but it also lowers, like Scott just said, it lowers your anticipated reward on that particular trade.
So people, the next question that someone would ask is, well, what do I do? Right? Here's what it is.
Right, exactly.
Here's what you should think about. If you're going to play for a big move, then play for the big move.
Right.
Right? Don't spend $2.24 and only play for a 75-cent winner.
Right.
If you're going to go for the big win, go for the big win.
Right.
Right? If you think it's going to go outside that range, play that. Don't cut yourself off.
And I wanted to kind of do this on this, guys, and just do the set slices to break even on this. On the long straddle, you got to remember the probabilities are against you on this
60,
particular
what,
trade.
66.55 and basically 60.45 are your break evens. Or 59.45.
59.45.
But the key is still, this is 100% risk defined.
That's right. That's all you can lose is that 355.
Yep, and that's the key, because you can sleep at night. You hope for that 2 or 3 standard deviation move post earnings, and you've only got 2 days in the
And the
trade.
question that a lot of people, a lot of customers, a lot of viewers ask is, well, how, I keep putting on iron condors and I get a big move and I lose money. What makes money? That makes money on a big move.
Yep. If your assumption is the opposite of an iron condor, and you think you're going to get that big outsized move,
If you're sitting at your
way to
desk
play it.
saying, I see $3 and change big move, and that's not enough.
Right.
Something's going on, and then play that.
Yep, I see this stock breaking below 60, Kevin, like that support level, or I see it going back to all-time highs at near 70 or multi-year
If it goes
highs
to
at
$76, guess what? Winner.
Winner. It goes to $70.
Just
winner.
based on the math, right? Not based on anything other, but if you were playing for a big move, that is the way to do it.
Now, is there a trade that you guys are looking at here in Qualcomm as another example? Because I want to give our viewers as much takeaway on this type of trade or product as we can.
Well, I look at this and I say, volatility is pretty cheap. Now, is it cheap for a reason, right? Is there a reason it's only in the 55th or 57th percentile going into earnings? In this type of scenario, I'm going to look to buy some premium, whether it's on a calendar, whether it's on a what we call a strangle swap, where you're still playing both sides of the market, but you're doing a calendar put spread and a calendar call spread, so you're still looking for a move in either direction. I'm going to try and identify something where I can actually buy some premium in this one.
Okay, and long calendars take advantage of that where you're buying Vega actually, because you're selling the near term, buying the long term. Kevin, you have something in mind?
I'm looking at something here. Hold on, let me take a look. I'm buying the 60 calls. If I go in here and look at
in January, 60 calls.
Out to January, so something in what Scott was just talking about, in the diagonal family, and then go to the expected move. Look, I only spent $4.32. I've got about 80 some days.
And that's a stock replacement, Kevin, because you're buying the in-the-money Jans. It's risk defined. You can only lose what you pay on that. And I've got it clicked on here. Let's go. Yeah, go ahead and get rid of those. Clean those up.
There
so
you can
stock
see
replacement. That's neutral to bullish. You want this stock to go up above that $64, $65 level. Now you got some duration in this. You got about 2.5 months.
Yeah. So if you're wrong, you can still reduce your net debit by rolling, covering those and rolling into more shorts and extending duration on this trade. If you get a move up to $66 or so, right around there, close it. Take your profits.
Yep, and that's a good way to assess that. I kind of wanted to just hit on one thing that Scott said as far as maybe a double calendar or something like that. Scott, where you're playing both sides of this. And I'm just going to go out to the expected move.
Exactly, 1666.
But then I'm only going to go out maybe a month, okay? and I can buy that 60, and I can buy the 66. These are two long calendars, and that's creating about a $1.40 debit on this particular trade.
And you're always going to pay a debit.
Yep, on long calendars, right. So I'll click off the diagonal, get rid of that. And then there's your profit and loss on that. Now remember, volatility is going to fall. It's going to negatively affect this, but it widens out your range on this type of trade.
It does. And what you're really looking for is by Friday expiration and in the next day and a half, be it one of the two strikes, 60 or 66.
All right. Lots of trading here, guys. Thanks to Scott Bauer, CEO of Prosper Trading Academy, and Kevin Hinks. As always, that does it for Fast Market. Tune in tomorrow, 10 a.m. Central Time, right here on the TD Ameritrade Network.